DeRosa Insiders. It's Matt Faircloth. Super lucky, super blessed today to have Hervé Francois.
What's up, guys? How you doing? I'm in the house.
All right, guys, transitioning over to our guest for the day, right? This is somebody I've known for a while. I've been on his podcast a few times, and we're going to be talking about something that a lot of people are like, oh, that's boring. I want to talk about that. I'm telling you, this is something you need to know about because this is something that will make or break deals you guys may have coming forward in your business, right? So I'm going to bring in, you got to know him at conferences years ago, and we've had a lot of great conversations over the years. So I'm bringing in Jeremy Goodrich. Jeremy, how are you today, man?
Wonderful, Matt. Hervé, so good to see both of you. Excited to chat a little bit. I couldn't agree with y'all more about waypoints, goals, how you're building your business, how you're finding those rhythms. So thanks for sharing that with all of your listeners. And I couldn't be more excited to dig right in with you today.
Could you take a moment real quick? I believe this is your first time on the Cash Flow Digest show. Yeah. I've been lucky enough to be on your show a few times. I got another phenomenal guest right here for your show, by the way.
Love to have you, Hervé. Absolutely.
Thanks. But before we get into any of that other stuff, can you please introduce yourself to our audience here on the Cash Flow Digest?
Absolutely. So I'm the owner of Shine Insurance Agency. I've been doing this insurance thing for about 10 years. I was an elementary school teacher for 13 years before that. And when I switched from being a teacher to insurance, I really tried to bring the concept of being a teacher over to this side. So really just educating people about the stuff that I have, about what we're doing. You know, it's tough to teach a 10-year-old arithmetic. There's some, there's some explaining, there's some coercion, there's some belief that it actually will have some value in your life down the road, even though it feels like it has no value in your life right now. And that really did convert into insurance, as it turns out. I've been into property from the very beginning. I started with homeowners, then moved into residential investors, moved up to multifamily investors, and now I work with commercial real estate, asset managers, acquisitions managers, and developers of all sizes. I have clients from hundreds of units to thousands of units and beyond. So that's kind of the very quick version of who I am and where I'm coming from.
Love it, love it, love it. Let's hop in, man. Let's talk a little insurance shop, man. You throw out the first conversation bomb for us to get into on insurance.
Well, listen, ask, one of the more obvious questions that I'm sure a lot of listeners are asking. Jeremy, what truly is going on in the insurance marketplace that we've seen these premiums absolutely skyrocket over the past couple of years? And in some areas, particularly as we know, coastal areas, even much higher than the inland areas. Can help us put our arms around what are some of the driving factors behind these skyrocketing insurance premiums on the commercial level for us?
Absolutely. It's a great question, and obviously the first question that everyone wants an answer to. So let me kind of pull back the curtain a little bit. At the highest level, insurance claims have been higher than they've ever been in the past in the last 2 years. In 2021, the entire property world, property insurance world in the United States had about $6 billion in claims. In 2022, they had $26 billion in claim. That's a 6 times increase, or maybe not 16, that's a five times increase in the claims that are happening. In 2023, we eclipsed the 2022 number, about $32 billion of claims in the property world. So the amount of claims that are being experienced in the insurance world is exponentially 5 to 6 times what we were seeing just 3 years ago. So that's the primary driving factor. And then when it comes to particularly multifamily and habitational is one of the highest loss categories in the insurance world. So when you break down property, whether that's office or retail or industrial, self-storage or habitational or multifamily, you see that multifamily has some of the highest losses, both on the property side where people have fires or tornadoes or hail or things like that, and on the liability side where someone slips and falls on their front step and sues the property owner. So not only do we have overarching issues around losses, but when we look more specifically at multifamily, insurance companies are saying, hey, that's a sore spot in our book of business. And so what are they going to do? Well, especially when losses are high everywhere, they're going to say, let's get rid of our worst performers. And so they look at multifamily first and say, hey, let's get rid of this group of properties. And then on top of that, the worst performers in the multifamily world are those 1970s construction, Class C, value add, pieces, which I know a lot of your listeners are looking to pick up because they're low hanging fruit. You can get access right away, those kinds of things, right? And so insurance companies for those specific types of builds are saying even more, we want to get rid of those. So we're seeing standard companies like Travelers, Nationwide, Liberty Mutual, all of the companies that used to say yes to these properties, simply saying no. And when we have companies saying no, we have to go to now other layers of companies. It's a supply and demand issue, right? Now we have less supply, more demand, prices go up. So that was kind of a high level description of what we have going on and why prices are so extreme in the way that they're changing.
And I unpack some of that real quick. Why have claims increased, right? Is it, I've heard people tell me, oh, because of global warming. Like that's why insurance is going up, right? I've had people say, because post-COVID, whatever it is you want to drop in there, right? I've also seen more of these firms that are out there to say, that say things like, hey, I can get you new roofs on your apartment building, right? Even though your roofs are, arguably okay and they maybe have 6-7 years worth of useful life, I'm going to go and get your insurance company to write the check for that roof, and they'll go and be like, claims, like aggressive claims adjustment world, right? I've heard people blame those things on the increase in insurance claims that have happened. Maybe they're right, maybe they're wrong. Why do you believe claims have gone, as I understand it, from 6 billion to 20 plus billion to 30 plus billion in 3 years? That is an insane increase. Why?
So three top things. I mean, there's a more dynamic answer to your question, but I'll give you the top layer things and we can go from there. One is, there's no doubt that catastrophic losses are more significant in the last 2 years than they've ever been in the past. One example, in Michigan, I was just at a meeting yesterday where a company folks were talking about one hail claim in Michigan that was a $35 million loss happened over the course of 30 minutes across a span of Michigan, right? Michigan isn't used to having baseball size hail. Texas is used to having baseball size hail. Michigan is not. So we're seeing more extreme events. We're seeing a lot more events. So the events associated with these losses are just happening more often, whether it's tornadoes or hailstorms, or, we got lucky in 2023 around hurricanes for the most part. There was one in Florida, but really not a lot of others. And that was a real positive. Actually, we're seeing in 2024 some loosening of the price. 2023 was one of the worst, what we call hard markets in the insurance world that we have seen. It's still a very hard market, but 2024 looks a little better. Assuming we don't get a bunch of hurricanes, we may be in a little bit better spot as we get to the end of 24, 25. So the first thing is those catastrophic losses like you talked about. The second thing, Matt, just like you talked about, is these claims aggressive public adjusters, particularly who are just trying to get anyone and everyone new roofs. Insurance companies now know how big the roof is on a property and decide whether to say yes or no based on that. It's because of things like LinkedIn. You and I know how well to use LinkedIn. There's also people out there using LinkedIn in kind of a bad way, and public adjusters doing exactly what you said. The amount of public adjuster involved losses, and a public adjuster is someone like a personal injury attorney where you hire them to get as much money as you possibly can out of the insurance company, right? Those folks are much more prevalent, and so losses are going up from that. And then the third and last thing is that liability and litigation law is attorneys are getting better and better at getting more and more money out of insurance companies. There's always an ebb and flow here, but we've all heard of the story where someone fell over, broke their arm because of whatever, and then sued an insurance company for $200,000 and won. There's a long conversation around why that is the way it is, and it definitely depends on the state as far as how things play out. But the losses on the casualty side or on the bad things that happen to other people's side are a big part of why we're seeing those losses increase.
So, Jeremy, thank you for that. That's a really good explanation. That makes a lot of sense. Yeah, really similar to feedback that we've been getting from other folks out there. When we look forward, understanding how aggressive these premiums have gotten on commercial real estate properties, specifically multifamily, what kind of recommendations are you giving multifamily buyers, operators on things that they can do that can help lower their insurance premium? And I would say it in two factions. Number one, on their existing portfolio that they've been holding on to a while, and then number two, for new properties that they are taking a look at to acquire, what are some of the things that they can do to help pretty much, if you will, underwrite, a manageable insurance premium for that particular deal?
Great question. So a couple of things. The first thing is having a good advisor, having someone who knows commercial real estate, someone who has access to all the best options, someone who can explain things simply. If you get on a call with your advisor and 15 minutes later you feel dumber than you were before about insurance, you've got the wrong advisor. So I think that, folks can listen to me talk about these things and go out and try and help themselves. But ultimately, just like any other role, whether it's property management or accountant or lawyer or broker, you want your insurance advisor to be a member of your team, a true part of your team. You trust that person, they're going out for you. That's number one. Number two, you've got to avoid small claims. These public adjusters in particular are out there trying, I have a portfolio where there's about 1,000 units in this portfolio. When you've got up to, when you've got 1,000 units or more, I can do a lot of creative things to keep your insurance premium down. But when I've got 6 or 7 small claims on the record in the last 2 years because a public adjuster came in and talked them into making a $20,000 claim here or a $30,000 claim here, my options are incredibly limited. And so you've got to understand, yes, insurance is there to take care of you when bad things happen. But the way it's set up, it's also going to penalize you if you have claims. And so, and this is true for home and auto, this is true for residential investment,
Sure.
this is true for commercial. You cannot make small claims. It's just going to burn you on the back end and take away the potential for the best price. As far as your existing portfolio, if you've already got one of those 70s construction apartments, you found out there's aluminum wiring in it, you thought you were going to do a value add, and you're doing that value add, and suddenly your insurance is twice as expensive. I mean, you can only do so much because you already own it. But I think the big things you can do is make sure those renovations are known by your insurance advisors. Make sure you're addressing the big cost stuff, or the big, aluminum wiring is a whole conversation in and of itself. If you see that a property has aluminum wiring, that is a huge red flag, not only for the safety of your tenants, but also for the cost of your insurance. So those are some of the things with the existing portfolio. Obviously, an acquisition, coastal insurance is as volatile as it has ever been, whether that's Florida, Texas, Louisiana. If you're going to buy coastal, you really need to understand what you're doing. And then obviously, again, back to that 70s construction and knowing what is going on in the property. So I don't know if that was too fast or right where you're going.
No,
that's
man.
Yeah.
But I just want to comment on something, because I don't think that people correlate sometimes claims to premiums, and they realize that, like, well, I had had something small happen that was on a larger apartment complex, $10,000, $15,000, $20,000 just above the deductible or something like that, or the minimum the insurance company is going to kick in on, and I'm going to file a claim, not realizing that probably is going to come back and backfire on you. Not even if you change carriers or go to another carrier, they're still going to see the loss run from prior work that you had. So I think that you've got to look. To me, insurance seems to be like a long game. That you've got to use it like a case of emergency, break glass, right? Like, but don't break glass all the time. Don't get over there and just use it for whatever comes up. Consider paying out of pocket for things, just to keep your premium down.
Yeah, and it really does save you a lot of money. I know it's counterintuitive, especially when insurance is so expensive, and you're like, this is what I bought it for. Why wouldn't I use it? And I don't have any argument against that. I totally understand that. I just understand how the industry works and the negative effect that's going to have on you in the future.
Yeah, good stuff. So, like, somebody getting into the game here, right? Because a lot of our folks that are on the Insiders channel, or students or whatever, are coming into the game with, like, they're scaling up from maybe a portfolio of singles and small multis. And guys, keep the questions coming in that. So they've got small portfolio, and they're looking to scale into small to mid-size multi, 10, 15, 20, 30 unit deals, looking to maybe land their first 100 unit deal in the next year or so. What guidance would you give somebody who's looking to level up in the next year or so with regards to how they should be playing the insurance long game, so to speak?
Well, I think number one is to understand it's not just insurance, but lending as well, that 1 to 4 unit buildings are drastically different than 5 units and above. 1 is considered residential, 5 units and above is considered commercial. And so on the lending side, that has a significant effect, even how they value the property, as I'm sure you've talked about many times on the show. And on the insurance side, it's different as well. If you've got a 1 to 4 unit property, you can go to your standard insurance company, your home and auto insurance company, and go get a quote for that. There's lots of places to do that in that way. Once you're getting into those bigger properties, now it's a commercial policy. You're buying a business, right? When you buy a 100 unit apartment complex, it's like buying a Target store down the street or whatever. It's not like starting your own startup and going out and mowing some people's lawns and seeing if you can grow that. That's a little bit more, 1 to 4 family properties. You can do that a little bit more. You can put it all on your own shoulders. You can go and change those, deal with toilets and termites and tenants and all that kind of stuff. But you've got to understand as you get bigger that it is more of a commercial exposure. That means, as I'm sure you say many times, that team is more important than anything else. You've got to know who your lawyer is. You've got to know who your accountant is. Of course, you got to know who your property manager is. And you've got to have a good insurance advisor. So when it comes to scaling, I think learning that concept around trust but verify, finding that right advisor, making sure they're good at what they do, and then trusting them to serve in that role is going to answer all the questions like we're doing on this show. So that would be my best piece of advice to someone who's scaling from the small stuff to the bigger stuff.
Jeremy, what kind of components within an insurance policy have you been seeing operators perhaps start to cut back on now in order to go ahead and find a way to go ahead and lower their insurance premiums? We've heard things as, particularly, let's say, for example, in the state of Florida, if you agree to mitigation with your insurance company versus having to go to court, that would result in the lowering of the insurance premiums. What sort of things like that have you been seeing that operators have been potentially cutting back on, even as much as that could be a risk to their property? in order to help lower their insurance premiums?
Yeah, I think there's the good things I see people cutting back on and the bad things I see people cutting back on.
Right.
And the good things, I think, particularly increased deductibles. This is an obvious one, and most people understand that you can take on more of the risk by simply increasing your deductibles. I had a scenario recently where I had someone with a $2,500 deductible on their properties, and they had kind of fought me on it. And I'm like, okay, if you want it to be that low, that's fine. And at a renewal, we had some insurance premium go up. And I was like, look, if you change this from $2,500 to $10,000, it's going to save you almost $4,000 a year. Right. So you start to think about the math, and it's like, hey, sometimes saving money by just raising your deductible is the best way to do it. If you're an investor who, has some properties, you got to have at least 5K, 10K deductibles. I have clients who have deductibles all the way up to $1 million, where we start to get into captive insurance policies, which is a fascinating world that anyone who pays $1 million or more a year in insurance premium should understand and consider as a part of their scenario. So deductibles is the first thing that I would say people can, give back, I guess, to save some premium. The thing I see people doing poorly is just not knowing enough and choosing the cheapest price. And what happens when you do that is you get policies that have things like ACV coverage, which means in a claim scenario, they depreciate for the age of whatever it is they're replacing. That's a big negative. High co-insurance clause, which means if you underinsure, you're going to get penalized in a loss. And then the biggest thing that people do is simply underinsure a building. If you've got a building that's going to take $1 million to replace if it goes down, and you say, hey, I can save some money by insuring it for only $500,000 because I'm not likely to have a total loss on that building. $500,000 will cover me for most kinds of claims. The co-insurance clause on your insurance policy is built to protect the insurance company from that exact scenario. And you're going to end up getting just very little in an insurance claim. If you insure for $500,000, the total replacement cost of the building is $1 million. Even if you have a $100,000 claim, they're going to depreciate's the wrong word. They're going to use that valuation to cut about 50% of the loss out right at the beginning.
Yeah.
Minus
like that 50% discount tracks down to everything.
Yeah.
Right. Okay.
Yeah. Yeah. So those are the bad things I see people doing: underinsuring and thinking that's going to work out in a claim scenario, having ACV coverage or having high co-insurance clauses. I know those are words that a lot of your listeners probably haven't heard that much, but that's the bottom line.
What about does it save money in, being diligent about getting, co-insurance on things like having my tenants name me as additional insured, first of all, mandating my tenants get renter's insurance and then getting them all to name the landlord as additional insured, contractors working on site, having them always produce an insurance cert, just anything like that in getting certs and you have a better word for it, but doing things like that to make sure I'm covered by other people's insurance policies. Does that materially change our insurance exposure?
So, making sure you always have a renter's insurance clause in your leases and saying you have to have renter's insurance. Pretty much every insurance company says you have to do that. And so if you aren't doing that, then you could be potentially breaking the contract with your insurance company. A lot of advisors don't bring it up like they should, but you probably signed something somewhere that says, I do require renter's insurance. So it's not
print about that big.
Yeah.
Right.
So it's not necessarily that it's some huge discount. It's just that most companies require you to do that. And if you said to your insurance agent, hey, I do not require renter's insurance and I do not want to require renter's insurance, which especially for some LIHTC investors or, folks like that, they are in that position. It makes the companies we can go to a lot less. So renter's insurance is valuable for two reasons. One is if a renter causes a small fire, let's say they cause a fire, right? And it's $100,000 loss. Well, if their insurance policy can cover it, then yours doesn't have to. So that's back to not having any claims on your record. In fact, I advocate for tenant legal liability coverage, which is where you on your contract say, hey, either you have to have your own renter's insurance or we will provide it for you. We'll add $15 a month to your lease and we'll provide it. So on the back end, we have that set up so it's a small little insurance policy. That insurance policy actually only costs you about $7 or $8 per door to have. And so you're actually making money. It's kind of an additional, not CAM, but additional way to make money off of that. You're making $7 extra per tenant per month across your portfolio. If you've got a larger portfolio, that can be a really big deal. And then if there's a loss, that policy pays out instead of your own. So there's a lot of reasons to make sure your tenants have renters coverage. As far as certificates of insurance for subcontractors, it's the same conversation. You're just trying to not hit your own insurance policy because we know when you hit your own insurance policy, when bad things happen, that's going to end up costing you a lot more money. It also shows insurance companies that you have strong risk management strategies. And that's the last point I want to make here is that we have to come from a risk management mindset. We want to make sure sure that our property, our people, and our purse is protected, right? We want to make sure that the property is in good shape, that it's safe, not only for our tenants, but for our bottom line. And I think when we start thinking about it that way, insurance becomes more fun, for one, because we can sleep better at night, and it also saves us a lot of money on premium.
Love that. Love that. And we get a comment coming in that it's about, so in essence, what you're saying is that, getting insurance certs and making sure you're covered is obviously number one, just staying in compliance with your actual policy that you have,
Right.
but also just making sure that if you can defer a matter to someone else's insurance policy, but, if they're at fault, then you're able to do that. A tenant, roofer or something, so anybody doing work on your site, whatever that may be, as long as you're able to defer the claim over to them, then you can do that. And that reducing the claim thereby keeps my premiums lower for the future.
Yeah.
So
Yeah, absolutely. Go ahead, Hervé. Yeah.
Yeah, no, Jeremy, I was going to ask, granted, we talk a lot about multifamily here, but earlier you were stating that multifamily is one of those asset classes in commercial real estate that's been really experiencing some of the highest growth in insurance premiums over the past couple of years. If you were to rank the asset classes, if you can, self-storage, mobile home parks, industrial retail, so on and so forth, how would you go about by ranking them by those that have seen the most significant increases versus others?
Multifamily is significantly above everybody else by far. Self-storage would probably be the lowest. It's a little hard it's almost like who has the biggest roof. Because of the amount of roof claims, retail,
Okay.
and then retail has seen some significant increase because of liability claims, and retail, they have a lot of roofs. So it's, less. Retail would be one that's seen it a lot. Multifamily by far beats everyone else in the bad competition of who has the most expensive insurance premiums. And then office is almost a whole nother conversation, because office insurance has been really affected by the amount of vacancy. Obviously, we're seeing some shift in that, but vacant buildings is the most expensive property insurance. And so if you had an office exposure, now it's a vacant exposure, you're going to see some obviously big changes. So I'm deeply oversimplifying by just throwing out numbers for asset classes. Self-storage would be low, multifamily would be high, everybody else kind of in the middle.
And then where would you put hotels in that list?
Hotel's pretty high too. Hotel has had
Okay.
a lot of limited, again, the same thing as multifamily, where companies that used to say yes are saying no. And so we're having more struggle with that. Really depends on your risk management strategy. So if you're a part of a Hilton or a Hyatt or someone like that, then you are going to get better insurance premiums. It's going to be easier to access good policies because your safety systems are deeply entrenched. If you're an independent hotel owner, motel owner, Airbnb, well, Airbnb is a whole nother conversation. It's going to be a little harder.
Got it.
Good stuff. So a great conversation, Jeremy. Before we let you go, I wanted to just see if you can kind of bring it home here with where you think the future of insurance for multifamily. We're primarily multifamily operators. A lot of our students here are rising multifamily operators as well. So where do you see the future of multifamily going? Is there like a whole new dark horse that's going to come in and change the industry? Are things like you said, captive insurance going to become more prevalent? Do you think multifamily is going to continue to see 10, 15, 20% per year premium increases for the foreseeable future? Where do you think the future is long-term, short-term?
So there's two things that combine with each other. One is the underwriting gains or losses, which is the claims essentially, right? That we've already talked about in this conversation. The other side is what insurance companies do with money when they have it in their hands, and that is they invest it. And so, and the third, I guess, is that insurance company premiums are always an entire year behind the reality of the social situation, because they file for rate changes and those rate changes are approved by the government. And so there's almost a year-long delay in the process of things changing. So in 2022, the equity scenario was pretty tough. The stock market was not good. A lot of people lost money in the stock market. And as we already talked about, there were a lot of claims happening, which made 2023 one of the worst years for insurance premiums, period, right? And I go back a couple of years to get to the answer to your question. So 2023 was really, really tough, pretty awful. 2024, we're seeing some loosening up in property actual today stuff. The claims are a little bit better. Insurance companies are starting to deal with the roofers and change coverage to be more restrictive. And so it's a lot harder to just get that free roof in 2024 than it was in 2022. So that's happening as well. And the 2023 and 2024 financial markets have been doing pretty well. So knock on wood, we hope that continues. Given all those scenarios, I expect to see a loosening of insurance premiums, particularly in 2025. And obviously beyond that, it's a little hard to say. But I've seen some loosening this year, because 2023 was a good investment year. And so there's some loosening happening, but everyone's still tepid. They're still kind of tipping their toe into the water. And so we'll see if they start coming back. I hope they do. It really has a lot to do with what happens with catastrophic losses. And if we could ever get a handle on litigation stuff, I think that would be a really big shift. But I don't see huge increases. But if you're underwriting for properties, I also wouldn't go back to, 2 to 5% increases in your, pro forma as you're running forward. I think you have to say at least 10 to be safe in the way you're doing it. And if you've got a property in Houston, I would throw 20% in there probably.
Right. Yeah. Low-lying coastals are still going to see bumps, for all the reasons that you guys know. And so you got Jeremy's recommendation here, take it from the horse's mouth or from an insurance broker's mouth, is for you guys to underwrite to 10% increases on insurance for the foreseeable future. Yeah. And hey, maybe you get lucky and things come in at 8, save a little bit there. So good stuff. Jeremy, how do people connect with you, hear about you for the insurance programs you offer and everything like that? How can people reach out to take the next steps?
Sure. So shineinsurance.com is a great place. I have a multifamily ballpark tool. You put the address in, answer 9 yes or no questions. We'll give you a ballpark right there. Really, really good for underwriting. That's at shineinsurance.com/ballpark. I would just start using it. It's automated. It sends right to you the number. It's obviously not an actual insurance quote, but it gets you some, back of the napkin numbers to work with.
Guys, that's incredible. Let's write that down. shineinsurance.com/ballpark. If you guys are underwriting a deal right now, large or small, go to that website. You guys could drop in the address of the property you're underwriting, and Shine Insurance is going to give you not a bid, but a ballpark number. So you can take that, put it in your underwriting, and you know that if the number works, now you have an insurance carrier you can go to lock it in. So, and for those of you guys watching on Insiders Facebook, there is some links right there for people to watch. Everybody take it home. Final thoughts.
Hey, man, listen, this has been great, Jeremy. We cannot thank you enough, man. World of information. It's extremely timely as so many operators and owners are dealing with such a really, really just real life, just sensitive issue. This stuff is very, very impactful to people's portfolios, to people's returns. There are some muddy waters that we need some navigating on. So I think, it would be hugely beneficial for operators to team up with folks such as yourself to really help them navigate through those waters and figure out ways they can go ahead and make it through, some really, really tough times in the insurance industry. So thank you enough for wealth of information today.
Absolutely, Matt.
Jeremy, thank you. Looking forward to continuing to hang out with you, coming back on your podcast, talking more real estate shop. Am I going to see you at a conference anytime soon? Our DeRosa team is going in heavy for Best Ever in a couple of weeks. And of course, we're all lucky enough to be going to BPCon and Cancun, of all places in the world. How about yourself?
Well, I'll definitely be at Best Ever. I'll see you guys there. Maybe we can hang out. And BPCon, I don't know. I'm not connected with yet, but maybe I should go to that as well. So we'll figure it out.
You should. Yeah, let's talk more Best Ever. Come see Jeremy at Best Ever Con in just a few weeks in Salt Lake City. Jeremy, thanks for joining us for the Cash Flow Digest today, bud.
It's my pleasure. Thanks for having me on.
All right, Jeremy. Take care.
Yeah, great conversation. Insurance insurance is one of those things in real estate that just doesn't get enough attention. And in some ways, it's like the silent deal killer. Yeah, really when you're underwriting a deal, you're like, okay, taxes look good, utilities look good, everything looks good. And insurance,
right? All of a sudden,
I underwrote it for half of that, right?
Exactly. Exactly. It makes a big difference.
I love that ballpark tool he's got too. That's awesome.
Ballpark tool is something that we can use, right? I mean, you just want to be able to find out right away and whatnot. And you guys just absolutely need to team up with a great insurance broker, potentially like a person like Jeremy that's going to help you navigate through these really, really rough waters and whatnot. And there's, as you've been hearing more and more, Matt, I mean, there's, some interesting things that folks have been doing in order to help lower their insurance premiums, combining properties onto one insurance policy, multiple properties on one insurance policy to try to get that discount and things like that. So again, these are tactics that I'm sure that Jeremy can share with you as you're looking, on to see what kind of policy that you're looking to put on your properties.
Absolutely. Guys, check out Shine Insurance to hear more about that. And big kudos to Jeremy for joining us today. Hey guys, Matt Faircloth here. Thank you for listening again to the Cash Flow Digest. I really appreciate you guys doing that. If you guys want to hear more about what DeRosa Group has to offer, go to DeRosa Group, DEROSA Group.com, DeRosaGroup.com online. You can hear about all the great things that we offer from an educational standpoint and passive investment standpoint on our website. See you there. And if you guys want to join our online community, DeRosa Insiders on Facebook, where you can watch this program get recorded every Friday at noon Eastern, and you can come on as even a guest or ask questions on the show. We hope to see you guys on our online community, DeRosa Insiders. See you there.